Quick reminder, I'm not your accountant or financial advisor. Super rules get technical fast, and the caps I'm about to walk you through can genuinely change year to year. So treat this as your starting point, not your final answer. If any of this is relevant to your situation, get it checked before you act on it. Let's start with the number everyone assumes changed, but actually didn't. First up, the super guarantee rate, the compulsory percentage your employer has to pay into your super on top of your wage. This one reached its final legislated target of 12% back on July 1st, 2025, and there's no further scheduled increase sitting on the books right now. So for this financial year, it stays exactly where it was, 12%. If you're earning $120,000 this year, that's still around $14,400 going into your super from your employer, same as last year. Nothing to action here, just useful to know the increases have topped out, for now.
Second change, and this is the big structural one. Payday Super is officially here. From this financial year, your employer has to pay your super at the same time they pay your wage, instead of the old system where they only had to pay it quarterly. There's a small buffer. Employers get up to 7 business days to make sure it actually lands in your fund, but the days of super sitting unpaid for up to 3 months are over. For you as an employee, there's nothing to do differently. The benefit is automatic. Your super starts compounding sooner, and it becomes much easier to spot if an employer's underpaying or missing contributions, because you'll notice within weeks instead of months.
If you run a business, this is the one to actually sit down with your bookkeeper about. Payroll has to update, cash flow planning gets tighter, and missing a payday super deadline now comes with real penalties and interest, not just a slap on the wrist. If you haven't reviewed your payroll process for this yet, that's a priority this month, not eventually. Third, a quieter but important change for higher income earners. The super guarantee doesn't apply to unlimited income. There's a ceiling called the maximum contribution base, and above that ceiling, your employer isn't required to pay any more super on the extra income.
Here's what's new. This used to be calculated quarterly. From this financial year, it switches to a single annual figure, set at $270,830. Once your qualifying earnings for the year cross that number, your employer has met their compulsory obligation. Anything above it is up to you if you want more going into super, through salary sacrifice or personal contributions. If you're a high-income earner or you employ senior staff, this is worth knowing purely, so nobody's caught out assuming super keeps accruing at 12%, no matter how high your income goes. It doesn't. Fourth, the concessional contributions cap, meaning pre-tax contributions like salary sacrifice, personal deductible contributions, and your employer's compulsory contributions combined. This cap has increased from $30,000 to $32,500 for this financial year.
Concessional contributions get taxed at 15% inside your super fund, which for most people is well below their normal marginal tax rate, which is exactly why this is one of the most commonly used strategies to legally reduce your taxable income while building retirement savings at the same time. An extra $2,500 of cap room might not sound huge, but if you're someone who tops up through salary sacrifice every year, it's real, ongoing tax-effective capacity that wasn't there last year. Fifth, and this is where it gets genuinely useful if it applies to you, the carry-forward rule. If your total super balance was under $500,000 as of June 30th this year, you're not limited to just this year's $32,500 cap. You can also use any unused concessional cap space from the past 5 financial years, provided you haven't already used it. Here's the catch worth knowing. Anything unused from the 2020 to 21 financial year has now expired permanently. It drops off after this year and can never be recovered. So if you were planning to use really old unused cap space, this is close to your last window. For someone who hasn't made extra super contributions in several years and qualifies under the balance threshold, this can add up to a genuinely large one-off contribution capacity, potentially well over $150,000 in a single year once you stack the current cap with unused amounts from prior years. This is a particularly strong strategy if you've had a one-off high-income year, like selling an investment property, and you want to offset some of that tax bill by parking a large chunk into super. Definitely worth running the exact numbers with an advisor if this sounds like your situation, because the calculation depends heavily on your specific contribution history. Sixth, non-concessional contributions, meaning money you put into super from after-tax income, no deduction involved. This cap is always set at 4 times the concessional cap. So with concessional moving to $32,500, non-concessional rises to $130,000 for the year. One important eligibility detail: if your total super balance sits at $2.1 million or more as of June 30th this year, you lose access to this cap entirely. You generally can't make any non-concessional contributions at all in that case. So this benefit scales down and eventually disappears the closer you get to that balance ceiling. Seventh, the bring forward rule, which is the non-concessional equivalent of pulling future years forward instead of catching up on past years. Depending on your total super balance as of June 30th this year, you may be able to bring forward up to 2 future years of non-concessional cap and contribute a larger lump sum in one go. With the new $130,000 annual cap, the maximum bring forward contribution rises to $390,000 for those eligible for the full 3-year version. But this isn't one flat number for everyone. It's tiered based on your balance. If your total super balance is under roughly $1.84 million, you may access the full 3-year, $390,000 version. Between about $1.84 million and $1.97 million, it narrows to a 2-year, $260,000 version. And once you're between roughly $1.97 million and $2.1 million, you're limited to just the standard 1-year cap of $130,000 with no bring forward at all. One more important detail: if you already triggered a bring forward arrangement in either of the last 2 financial years and you're still inside that period, these new higher caps don't apply to you yet. You're locked into whatever cap applied when you originally triggered it until that period ends. This is a strategy that rewards planning ahead rather than reacting. If a large contribution is on your radar, whether from savings, an inheritance, or a property sale, timing it around your balance, and these thresholds can make a meaningful difference to how much you're able to get into the concessionally taxed super environment in one go. Eighth, the transfer balance cap. This is the lifetime limit on how much you can move out of the accumulation phase of super, where earnings are taxed at 15%, into a retirement phase pension account, where earnings become tax-free. This cap has increased from $2 million to $2.1 million for this financial year. If you're starting your very first retirement phase pension this year, your personal cap simply matches the new $2.1 million figure. But if you've already started a pension in the past, your personal increase won't be the full $100,000. It's calculated proportionally based on how much of your original cap you've already used. The less of your cap you've used previously, the more of that increase you get to keep. This is genuinely technical territory, and it's worth checking your actual personal transfer balance cap through MyGov or with a financial advisor, rather than assuming the headline $2.1 million figure applies directly to you. A few more figures tied to these changes quickly. The Division 293 threshold, the extra 15% tax high-income earners pay on some concessional contributions, stays unchanged at $250,000. The downsizer contribution limit, letting eligible people put proceeds from selling their home into super outside the normal caps, stays unchanged at $300,000. And the lifetime CGT cap for small business owners selling qualifying business assets into super has increased to just under $1.94 million, up from around $1.87 million. A smaller, more specific change, but genuinely valuable if you're in that exact situation. And finally, the one getting the most attention, Division 296, sometimes called the extra tax on large super balances. This legislation has now passed both houses of Parliament and officially applies from this financial year. On top of the standard 15% tax on super earnings, an additional tax now applies specifically to the portion of earnings attributable to balances above $3 million, with a further tier above $10 million. For the very first year this applies, your total super balance is measured as at the end of this financial year, not the start. After that, it shifts to using whichever is higher, your opening or closing balance. If your balance is anywhere near that $3 million threshold, this is genuinely worth a dedicated conversation with an advisor, because the mechanics of how the tax is calculated are more involved than most other super rules. That's every major super change for the new financial year, new caps across the board, a completely new payment timing rule, and a brand new tax for large balances that simply didn't exist a few years ago. Quick reminder, I'm not your accountant. This is general information, not personal advice. Super strategy depends heavily on your individual balance, age, and goals, so get anything specific checked by a professional before you act. If this helped, hit subscribe. I break down every super, tax, and money rule change in this country as soon as it lands. See you in the next one.